Hey Bowtie Nation, Joseph Hogue here with the stocks that are gonna save you from the 2022 stock market crash. The S&P 500 is now down 8% for the year, with 1 in 5 stocks down more than 20% just this year. But history can help you avoid the worst of a stock market crash and even make money. The market plunged 55% from October of 2007 to the low of March 9th, 2009, but 236 stocks actually beat the index and 8 produced positive returns. We also saw 183 ETFs beat the market, with 58 of those producing a positive return through the crash. In this video, I'll dig into research you won't see anywhere else to show you the sectors, ETFs, and stocks to buy. I'll highlight the stocks and funds that actually made money in the last stock market crash and show you which I'm buying. You know, we can't get started though without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to thank Hogue, the CEO over at StockCard, for getting me the data on this one. I'll leave a link to StockCard in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow and you'll get notifications whenever I buy or sell from the list. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation for an exclusive discount beyond the free trial. I want to start by looking at where the most pain has been in this year's stock crash, give you a feel for what I'm watching. Here we are on sectorspider.com on the sector tracker tool and looking at 2022 year-to-date returns for each of the 11 stock sectors. And you can see it's in technology, communication services, which is all of those internet and social media companies, and then consumer discretionary stocks that have been hit the hardest. That's no surprise, as the stocks in these tend to be those riskier, growth types of stocks that fall faster in a crash. And it's here in some of these three sectors that I would actually start to look to pick up some great deals later this year or early next in some of those long-term growth stocks. Investors love buying into those growth and tech stocks as the share prices climb higher, but forget, when prices start falling, that can be your best time to get into some of those long-term investments at a discount. But we could still be in the early innings of the sell-off, so here we want to focus on some safety. And besides energy stocks, which have seen a massive run-up on oil prices this year, it's really those two traditional safety sectors like utilities and consumer staples really doing well. Again, not really a surprise though. The companies in these sectors sell things you have to buy, like electricity and food, so their cash flows are going to be strong even in a recession. But I wanted to go deeper into the research on this one, not just rely on that conventional wisdom for which stocks or sectors tend to hold up in a market crash. I wanted to actually look at the returns in 2008 crash to find the stocks and the funds that not only protected your money, but helped grow it. So I reached out to Hogue to run me a search on all the stocks and ETFs from the peak of the S&P 500 in October 2007 to the absolute bottom, March 9th, 2009. And what we found went way beyond some of those old investing rules for safety. I'll start with the sectors here to give you that big picture, but next I'll show you exactly which ETFs and stocks beat the market. First, we'll change the type here to sector and sort by the return to put these in order. And again here, we see that stocks in the consumer staples, healthcare, and utility sectors all held up well, outperforming the drop of 55% across the market, with staples only falling about half that amount, so really living up to its safety status. Stocks in the consumer staples sector lost 28% on average, with utilities losing just over 40%. And today, it's interesting that stocks in the consumer staples sector have been hit so hard on inflation over the last year, as a lot of those food processors like General Mills and Conagra Brands face higher costs. But I think most of that was in that supply chain issues, which is now really working its way through and could be less of a factor for the rest of the year. So besides this idea of that safety from a market crash, stocks in this sector, the consumer staples, could see better earnings growth and an upside on the share prices. Now I want to look into how specific ETFs did during the crash, where we might be able to protect ourselves with those broad, diversified funds. So I'll change the type here again to ETF and again sort the data for the best returns. And I guess it shouldn't surprise us that the ultra short funds did really well, some posting returns in the 100 and 200% range. These funds are set up to leverage the opposite of the return on the indexes or the sectors, typically shorting futures contracts on the indexes and often using leverage of 2 or 3 times that. That means if the NASDAQ index falls 20%, then the short fund could rally in the range of 40 to 60% higher. Now for something like this, you might look at the ProShares Ultra Pro Short QQQ. That's ticker SQQQ, which is going to take that leveraged short position against the tech-heavy NASDAQ. Now, these aren't so much long-term investments because the fees are really high, but they can be used to hedge your risk in other stocks, benefiting in the short term if the market falls. I'm not sure I want to short the market, but just want to find some investments that can still do well even if the market keeps falling. So we're going to keep scrolling here, and we see that gold and bond funds also did well, which is typical in a stock market crash. You've got ETFs like the Spider Gold Shares, ticker GLD, which are backed by gold deposits, and then those iShares 20-year Treasury ETF, ticker TLT, which benefits because as interest rates fall in a recession, bond prices typically go up. Now the problem here is that gold still seems a little expensive, and interest rates are likely to go up instead of down over the next year. Even a 40-year record on inflation wasn't enough to break the price of gold out of its range. It took the threat of a world war and a market crash to send that gold up to 2,000 an ounce. So I wonder how much value is really left if things get worse. Now for bonds, I do think you can find some safety in some of those shorter term bonds like the Vanguard Short-Term Bond Fund, ticker BSV. It pays a 1.4% dividend, and short-term bonds don't fall quite as much when interest rates rise, so you're not going to lose quite as much as you would with other bond funds. The exception to this in bonds is the Series I savings bonds, which includes an inflation adjustment, so the interest you earn actually goes up with higher prices. This is one of the best opportunities for investors right now, that protection of a bond and interest of 9% and higher. I actually did a video of this on last week that I'll link to in the description, so make sure you check that out. Now for the good stuff though. There were over 200 stocks that beat the market during the last big crash, but only 8 posted positive returns. We'll start by switching to stocks here and then sort by that return. Now here I wouldn't say rush out to dump all your money in Netflix, but there are some real lessons looking at these stocks that outperformed the market. We see the 3 major auto parts retailers here with AutoZone, Advanced Auto Parts, and O'Reilly Automotive, with AutoZone posting a 22% gain. And remember, this is while the S&P 500 index was falling 55%, so even that small 6% loss on O'Reilly would have been really nice. Now I'm thinking some of this may have been from that Cash for Clunkers program, which started later in 2019, but the automotive stocks really started rebounding earlier. The industry was also doing really well before that though, just on the idea that if people aren't buying new cars in a recession, they're going to need the parts to fix up their old ones. And we do see AutoZone, ticker AZO, started outperforming the market well before that Cash for Clunkers program. Here, shares of AZO in blue and the S&P 500 in red really started to diverge in 2008, so there does seem to be some safety here in those auto stocks. And I think either of those 3, AutoZone, O'Reilly, or Advanced Auto Parts, will help protect your portfolio. This is a year-to-date chart, and all 3 are outperforming the 10% loss on the S&P 500, though Advanced is just barely with a loss of 9%. The other 2, though, AutoZone and O'Reilly, are both posting positive returns this year. Now, Advanced Auto Parts, ticker AAP, is the cheaper valuation, though I think AutoZone has a stronger competitive advantage in the business. You also see real strength in the discount stores, Ross stores, and Dollar Tree, along with the low-price leader, Walmart. Now, this is on that idea that as people face a recession and maybe a weakening labor market, they start thinking harder about prices and saving. Of the 4, Ross stores, ticker ROST, Dollar Tree, ticker DLTR, Walmart, ticker WMT, and Dollar General, ticker DG, only Ross Stores is underperforming the S&P 500 so far this year. Ross Stores is a more consumer discretionary retailer rather than the groceries and staples sold to some of these other 3. I like Ross though. Of the 3, it's the only one selling at a discount to its 5-year price to sales ratio, a discount of 16% in fact. Walmart is trading for 23% above that average 5-year ratio, while the dollar stores are even more expensive at 52% premium for Dollar Tree and 29% premium for Dollar General. The drug makers also did well in the last stock market crash, with Gilead Sciences, Abbott Labs, and if you scroll down a little, Amgen. If it was just 1 or 2 of these biotech or pharma companies, I might chalk this up to breakthroughs at a specific company, but this was broad strength around the drug makers, and I think somewhere else you can look for safety. Even though it's come down recently, I like AbbVie, ticker ABBV, for its safety and long-term growth, along with that 3.6% dividend yield. Analysts have an average target of $162 a share, about 5% above the current price. Now, scrolling further still, you get a sense of that safety in consumer staple stocks, with other names like General Mills, McCormick, and Hormel Foods. All 3 of these fell during the period, but were well above the losses we saw in the overall market, and their dividend yields helped soften that impact for investors. In fact, Altria Group, ticker MO, pays a 6.5% dividend yield and is up 15% so far this year, beating the market by 25%. Check out the 2022 portfolio on StockCard or click on the video to the right to see the 11 cheapest stocks in every sector, the best value stocks in the market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.